My name is Yi, strategist of Phillip Futures. So today we'll be discussing about how you can apply technical analysis for your outlook on gold. If you can hear me, just type yes in the question box so that I know that you can hear me. So that there's no connection issues if you can't hear me. If you feel that it's broken, the volume is broken up, you can just plug your earphones and plug in again. Right, when I see enough yes, I'll just continue. Okay, I'm starting to see some yes coming along the way. As we go through this webinar, if you have any questions, feel free to type in the question box as well. Alright, without further ado, I'll just begin. Okay, before I move on, there will be a quick disclaimer. Whatever I'll be sharing in this presentation today does not constitute investment advice. If you need to trade, please perform your due diligence or seek advice from your financial advisor. So on to what we will be sharing today. From a high-level perspective, we cover level 1 is trading and before we begin. Technical analysis to understand what the value is. And then we'll dive deeper into the 3 key elements of trading that more specifically your entry trading activities. Right, then we'll dive deeper into these 3 elements and break it down for you how do you identify the activities. Fourth, we'll cover common mistakes that normally followed by some So this checklist will allow you to know that you have fulfilled all criteria before you enter markets. And third, it gives you a clear definition of the parameters within a strategy. So we'll talk a little bit more about what a strategy is later on as we'll see. So why is this important? Why is having a trading plan important? Because it helps you to track which strategy works and which does not. Now with so many strategies being available, simply by just searching it on Google, how can you know definitively which one works and which does not? The answer sometimes depends on your personal trading style, which suits you and which does not. So the only way to do that is to keep tracking the strategy that you are using so that you will know whether this works for you or not. So secondly, it keeps you from trading consistently. There's this thing that trader form is called gut feel. Each time you trade the markets, you look into your emotions so a trading plan is so this leads to the last point. Managers watch so there's a huge topic that's covered on the internet psychology-wise important how not to fall prey to certain trading psychologies. For example, cutting your risk early and allowing your business to run. So that's called trading. So that's why it's important. Now, so what does a trading plan encompass? Now that you comprise of, now that you know that it's important, what does it actually encompass? So number one, it tells you what is how much you need to two, what must happen before you decide to enter a trade, exit rules, so what must happen before you decide to exit a trade, last but not least, what do you do after? Now some of you may get questions like, oh, there's something that you can do after placing a trade. The answer is yes, but for the scope of today's presentation, we will only dive into entry rules. So if you want to hear more, or if you want to have a webinar on creating your valuable trading plan, comment in the question box and we would like to see why, and so that you can plan for one. So next, what are the three key elements of strategy? So what are the three key elements that I'm talking about here? Let me explain. So I'll be sharing this on the context of the trend following strategy. There are many strategies that are available out there. It's trend trading, counter trend trading, momentum trading, breakout trading, and different types of trading. But for this presentation, this scope will be covering these four strategies. So the first thing you need to do is to identify what trend is currently. Is it upwards or downwards? So you think that it's very obvious to identify what is the trend currently, but sometimes when you look at life size charts, it's not that easy. So that's something that we'll look at later, but people keep saying and so it's a tool you use to identify the trend. Next, it's your key areas of trend. So what is press the value where is the trend help you all of these people must align on the for elements so just going to go what first, what you need to identify so if you look up or down trend, right? Is this an up or down? If you know the answer, put that in the question box as well. Okay, I'm seeing some comments that the audio is muffled. So for those who hear that the audio is muffled, you can unplug your earphones and plug it in at all. It's going to take some time for you to do that. So it's clear. You can hear me now. Type yes, so that I know that I am here. So right here you can't tell if it's a clear uptrend or downtrend because the market is moving. One pattern higher and one pattern. So for example, you start what you want to do is to identify the trend. So over time frame, let's say 1 hour, 4 hour time frame, you would want to identify the target. So this gives you a better understanding of what the trend is. So a common time frame to use or a common exponential moving average time frame to use would be the 100 and the 200 exponential. Now, so how do you determine if it's an uptrend or downtrend? So if the EMA is pointing upwards and price is above the EMA, it is taken to be an uptrend. So conversely, if the EMA is pointing downwards and price is below it, it is taken to be an uptrend. So as you can see over here, the chart towards the right hand side where the cursor is, we can see that the 200 EMA is actually pointing downwards and prices are residing below it. So this is actually a downtrend. Right, so not so obvious at first glance, but once you apply the knowledge, it becomes obvious. The next thing is by using trend lines. Right, so what are trend lines? So trend lines can also have a trend line where it's a trend signal you by so by one look, you can see by connecting the three lower lows, you can see that this is forming a trend. So in the same way, when you establish a trend, you want to look at one time frame larger. So how you connect a trend line is by connecting three consecutive low points, right, to form an upward trend. So if the gradient of the line is pointing up, then that will give you a good indication it is an uptrend. So it is pointing downwards, connecting three consecutive high points, right, it will give you a good indication that this is a downtrend. So that's the lesson read on trends. So I've covered two ways that you can identify the trend, the larger trend, by using different tools such as a trend line. So the lesson is that unless a major reversal happens, prices tend to follow the trend. So whether it's an uptrend or a downtrend, it tends to stick to the same trend until something happens before the trend reverses. Right? And once the trend is identified, what you should look to take is only positions that follow the current trend. The next thing you want to deep dive into is finding key areas of value. So this is your support and resistance. But there's so many ways of identifying support and resistance. We will be able to cover a handful of them, 4 key ways to do that. So to identify support and resistance, market what you use a setting. Basically connect three lower points for an uptrend, higher points for a downtrend, and draw the same off the next side. For ascending, so if you follow that constantly, so this channel is sloping downwards, so lower band acts as support, upper band acts as resistance. So support is actually as we explore the prices low, this is how we another way to identify support whether it's fixed. So you can see on the right chart, there are three horizontal lines that we marked up and circles. Right, so 4 circles, 3 circles line a horizontal plane. Right, so that indicates that prices have reached that horizontal line 3 or 4 times respectively. So that will form the basis of what we establish as a support and resistance. So the only exception here, if it is the highest and lowest point of the chart, as you can see from the circles at the extreme ends of the chart. So those are automatically taken as the support and resistance. Right, so how do you draw horizontal lines? To validate support resistance, you must ensure that there are at least 3 price points coinciding with that horizontal line to validate the support resistance. The next way that we can use to identify key areas of value would be through the use of multiple exponential moving averages. So earlier we covered how do you identify trend. So one of the ways is to use moving average. In the same way, you can also use exponential moving average to identify key areas of value. So what you want to look out for here is which price, or rather which moving average does price tend to fall back into. But if you look on the left example, you can see that for the red exponential moving average, the 100 EMA, prices seems to bounce off it a couple of times. So that is what makes it a key area of value you want to look out for. And if you look to the right hand side example, you can see that prices are bouncing off the blue line, right? So that makes it a key area of resistance. So the idea again is to spot where does buyer and seller congregate and move away from. So the third way to identify this is one of my personal favorites. It's through the use of Fibonacci retracement. So Fibonacci retracement is a drawing tool that is available on Phillip MetaTrader 5. Basically, it has 6 different percentages that tells you that these are key areas to look out for according to the Fibonacci ratios. Right, so what you would do is to pick the highest point and connect it to the lowest point, and automatically you would see the formation of the Fibonacci retracement. So what do these different percentages mean? So these different percentages mean that prices tend to move towards and away from them, right? Helping us to identify crucial points to look out for. And so that's the lesson wrap on areas of value. So what we want to do is to identify support and resistance that points out area in the chart that prices tend to move towards and away from. By understanding that structure or understanding that value adds one layer of certainty to assessing our future direction of price movement. So the key thing about technical analysis is we always want to add more points of validation to ascertain that where we project the price to be is correct. So it is not just based on gut feel, but it is based on something that is based on a methodology that we can plot out on the charts. So moving into the third point for our entry signals. So the third thing is to identify trade triggers. Right? Just to recap, trade triggers are the signs that tell you it is time to enter the trade or place an order in the market. So what are these? So I've broken them down into 3 different parts. The first one would be the Japanese candlestick. In this example, you can see a bullish and bearish. So you might ask, what's the difference other than one is green, one is red? So let me break it down for you. So the Japanese upper weight, body, part that bottoms up and bottom will be the price. So closest above, why the high, whatever. 1 hour time frame, 1 day time frame, or 1 week time frame. So that's dependent on the time frame that you are in. So what's the difference with the bearish candlestick? So the high price remains the same, the lowest price remains the same as well. So now the difference lies in its open and close price. So a bullish candle opens low, closes high. A bearish candle opens high, closes low. I hope this makes sense to you by listening. So this is how we differentiate different candles. So what are some candlestick patterns? I'll cover 4 powerful reversal candlestick pattern in the next few slides. So candlestick patterns are basically similar to technical indicators. They are not meant to be used on its own, but it is powerful when used with other factors to confirm what is the general significance of the price direction. So the 4 that I cover are the bullish engulfing, hammer, star. Right, so you can see the data plot just because that's the opposite of what we do. So basically, something bullish, flip that to the market version. So the first example, this is pattern I want to show you is the doji. Price was so there's 2 versions of it along with the doji. So if you spot this, what it actually is indecision, significantly high or low point in the market between buyers and sellers. So this indecision usually leads to a reversal. Right, so this is what I mean. So in this diagram over here at the bottom right hand corner, you can see a chart. I've marked out the support and resistance in orange horizontal lines, right? And we spot a doji, a long-legged doji resting at the resistance. So what happened subsequently was that price started to move lower. Right, next pattern would be the bullish engulfing. So there are certain prerequisites when it comes to recognizing different candlestick patterns. So this complete pattern consists of two candlesticks. It occurs when prices are in a series of downward trend. Right, as prices are moving downward, you view this pattern, and when you identify this pattern, it tells you that price usually would be moving upwards. So the black candle is a bearish candlestick, and the next candle on its right is a bullish candle, and the body of the entire white candle should cover or engulf the entire black candle. So this is where the name is derived, bullish engulfing candlestick method. So when that happens, prices tend to reverse upwards after this occurrence. Right, so the bearish engulfing would be the complete opposite. Prices are moving in an upward channel, upward trend, and then you do the bearish engulfing candle, and price will tend to reverse lower. So the third pattern would be the hammer. It occurs in a series of downward moving prices. Alright, and based on the anatomy of the candle, this is how you understand it. Price open high, went all the way to the bottom to a low, and came back upwards. So what this represents is that the long shadow at the bottom represents the bull attempt to stop the bears being successful. So the bears try to push the price lower, but the bull succeeded by causing the price to get higher. So what happens is that the price tends to reverse upward after this occurrence as well. Right. So the last pattern would be the evening star. So the evening star consists of three candlestick pattern. It occurs when prices are moving upward. It's characterized by one white candle on the left, a second smaller body candle gapping upwards, and another bearish candle gapping downwards on the right. So when you see this pattern, do remember that these are the prerequisites that you find in the star. So what usually gets this gap as a star is the same pattern without the gap. Right? But it has to have a gap to be classified as. So what happens is that price will open in the star. So the next thing would be chart patterns. So do bear with me this segment, put it right as I cover the technical going forward, but very soon I'll explain the combination of accessories which you get a chance of it. So we're going to cover 5 patterns. Over there I have a total of 9, but 4 are graded to show you that whatever we cover today is not the entire list of chart patterns that are available. There are actually more than out there, but what I'll cover today are the popular ones. So the black Pennant, falling and red, head and shoulders, and another popular pattern. Right, so what is black? So this is a black pattern. So in the same way, there are certain qualities that characterizes that pattern. So in the case of the black, it is formed after a sharp spike upwards or downwards in the case of downward trend. So after the spike upwards or downwards, that forms the pole. Right? And what happens is that price will retrace slightly in the opposite direction after the pole is formed, and that is the flat portion of it. Right? So just imagine a flat pole with a pole and the flag jumping out. So this is exactly what this is a continuation. So what happens is that prices tend to see a gradual pennant. So the pennant looks something like a flag, right? The only difference here is that you notice in a flag, but in the same way, there is also a formation of pole that is expected where prices swipe upwards or downwards significantly to form a pole pattern, and instead of trending higher or lower as the flag pattern, it trends sideways, right? Means it's moving neither higher nor lower, and the result of that is usually a symmetrical triangle. So by joining the top portion, the high points of the chart and low points of the chart, usually you will have a triangle that meets or a symmetrical triangle. So this pennant pattern is also a continuation pattern. So it forms after a quick pause in the market, because we all know that the market doesn't just move in one direction all the way. If it's an uptrend, usually it moves in ebb and flow. So what same direction. So bearing in mind what I'm sharing with you now are the trade triggers. So the trade triggers are crucial for you to know when to take action after you've identified the trend and also the key areas of value, support and resistance. Right. So next we move on to a wedge. So this is a falling and rising wedge. So depending on the trend of the market, if it is moving upwards or downwards, of course, if it's moving in a downtrend, a falling wedge is the one that you want to look out for. If it's in an uptrend, a rising wedge is what you want to look out for. So it is formed when prices are moving within a range that seems to narrow as it reaches further and further. Right? It can be identified using two lines similar to the triangle, except in an angle. And this angle does not meet, unlike the symmetrical triangle, just that it narrows as the chart advances. So the difference of this pattern is that it is a reversal pattern. So spotting this means that usually price breaks out in the opposite direction once this pattern is completed. So as in the case of a falling wedge, what happens is that price tends to break upwards. So for the rising wedge, price tends to break downwards. So that is why it's known as a reversal pattern. So one classic pattern that is extremely popular with technical traders is known as the head and shoulders. So why is it called head and shoulders? Because it looks exactly like that. So if you look at the example, you can see the formation of three peaks, two smaller one and one larger one. So the two smaller peaks at the side are known as the shoulder. So the left and the right shoulder, and of course the larger peak in the center is known as the head. So this is on the left hand side, what we have the top head and shoulder, and on the right hand side we have the bottom head and shoulder. So there are four components to this pattern. These are the prerequisites. It has to have a left shoulder, a head, a right shoulder, and a neck line, right? So what does not constitute a head and shoulder pattern? When the height of the shoulder varies very much. So which means one shoulder is extremely high, almost the same height as the head, and the right shoulder just being much lower. So that would not constitute a head and shoulder pattern. So for a ideal head and shoulder pattern to form, it has to be equal, and it must be coincided by a neckline. So the neckline is crucial because it tells you when prices will potentially break, right? So this is a popular reversal pattern. So if prices are trending upwards or in an uptrend, and you see the formation of a head and shoulder, so what tends to happen after that is price reversing downwards. And in the case of a bottom head and shoulder, once you observe this pattern in downtrend, what tends to happen is that price will move higher. So the last but not least, and also another very popular pattern, is known as the double top and bottom, right? As the name suggests, this double top and bottom is formed by prices hitting a certain peak at a very similar level. right? This is very similar to another pattern known as the triple top and bottom, with the exception that this is only two peaks that are formed, right? So to explain this pattern a little bit more, so what happens is that prices actually reaches a top and bounces off a resistance for a double top. Um, and this indicates that buying power is becoming exhausted, right? The bulls are winning the bears. The bears are winning the bulls in that case. So that prices can't break the certain resistance. So which means to say that price has reached a certain threshold it cannot pass. So in the same way for a double bottom, prices keeps trying to break lower, but the bulls have prevented that from happening, which is why price rejection occurs. What does price rejection mean? Simply put, where prices are not allowed to go lower because of buying power that are residing at a certain level. So this is done 2 times, and after it is done a second time, what happens is that price usually reverses. So the thing about double top and bottom is that this is usually spotted in a longer term trend. So if you're trading in, let's say, in a daily time, a shorter time frame, let's say you're a day trader trading in 1 hour and 4 hour or below time frame, chances are it is less likely for you to see this pattern. But once you do, if you do trade in the higher time frame, this becomes an extremely powerful pattern, same as the head and shoulders pattern, right? So that concludes the chapter on chart patterns. Now we move on to the last form of trigger. So the last form of trigger is known as technical indicators. So whenever I cover technical indicators, I'm very careful because for many people starting out, technical indicators are viewed as the holy grail to trading. Right? So many people think that once they find the right indicator, just one of them, they will be able to apply that across all situations, and in every scenario it should work out to give them the ideal buy or sell signal. But that is not true. Let me break it down for you what a technical indicator is. So for those of you interested in the definition, it is actually a mathematical calculation based on historical prices of the current chart. Right? It measures a specific component of the price behavior, and its aim, of course, is to predict future price movements. And as I mentioned, it is used as a trigger for entry and exit points, and it works in tandem. Right? After identifying the trend, after identifying areas of support and resistance, this is the last factor or the last conforming signal that you need before you pull the trigger. Right, so there are many technical indicators that can be used, but for the sake of today's presentation within this scope, I will be covering oscillators. So oscillators are a very popular kind of technical indicators. They are commonly used, right? The characteristics are that it has 2 bands of extremes, right? So where prices tend to move toward and away from 2 bands of extremes. It is used to identify turning points. So later I'll share with you why is it so crucial for us to be able to identify turning points. And again, I emphasize it is used in conjunction with the other tools to affirm our projected direction. So again, the more tools that you have that is aligned to your projection of the market, the better it is, and the higher likelihood that prices tend to move in the direction which you project. Of course, again, trading is about probability, and it is about increasing that probability of win rate. So there's no 100% win rate in everything. Even if you have mastered everything you need to know about technical analysis, there is still no strategy that can assure a 100% win rate. So why did I use the picture of a pendulum swing? Because it works exactly like that. Right? A pendulum swing has 2 extremes which it tends to swing back and forth from, right, on the left and right. So a oscillator aims to identify for you where are the extremes, where is the limit where prices will tend to turn. So I will be covering 2 common oscillators today. One of them would be the MACD, and second is the RSI. Right, I will share its full name in the following slides. So MACD is also known as moving average convergence divergence. For those of you who dabble in technical analysis or know a little bit about technical analysis, this is familiar to you. This is one of a indicator that is almost introduced to everyone who first starts out in technical analysis. So it has two main components. It has one MACD line and it has a signal histogram. So what it does is that just like the arm wrestling illustration on the right, it helps us identify the strength and it helps us identify the price momentum, right? Just like viewing a arm wrestling match, you can tell who is the stronger contender just by how far the hand is leaning towards which direction and how fast does it lean towards. So the faster and further it leans, you know that one contender is stronger than the other. So the two contender in the context of trading will be the bulls and bears, right? Bulls being the positive one and bears being a negative price movement where price tends to move lower. Right, so a deeper look into the moving average convergence divergence, or MACD for short, there are two ways that this can be utilized. The first way, so I've highlighted it in a blue rectangle at the bottom of the chart on the right. I hope you can see it. So let me just backtrack and flash it a few times. So at the box at the bottom, there is the MACD indicator, right? So the first way you will go about using it is to gauge the MACD line against and the signal histogram line against the zero line, right? So if you see that both of them are above the zero line being the neutral point, that means that the bulls are stronger than the bears. Right? So it tells you that there is a bullish momentum and price is going strong. But in the event that you see that both the MACD line and the signal histogram falls below the zero line, that is when the bears have overtaken the bull. The signal has reversed where a bearish momentum is discovered. Right, so that's the first way. And in these two examples you can see, so in the first red rectangle and its corresponding square in the MACD indicator, you can see that as price moves down, the MACD indicator also shows that both of them are below the zero line. And on the right, in the green rectangle and its corresponding green square, you can see as prices move up, the MACD line at signal histogram also reflects that by showing that it is above the zero line. So again, a measure of momentum and strength. Right. So the second way that a signal histogram, a second way that the MACD indicator can be used is the comparison between the signal histogram and the MACD line. So what you would see is the example in this case, the red rectangle, where prices are moving up, but you can see that both MACD line and signal histogram is below the zero line. But what's interesting is that you can observe that the histogram is slowly moving above the MACD line. So this is showing that the bearish momentum is weakening. Right, so instead of an outright indication of a bullish or bearish momentum, it also tells you whether a certain prevailing trend is strong or weak. So the reverse is also true. You can observe that in the green rectangle on the left, prices are moving downwards, but you notice that in the MACD indicator, actually both of them are above the zero line. So what's happening there is that you can also tell the histogram has fallen below the MACD line. So this is proof that the bearish momentum is weakening. So this is how we use the MACD indicator, two ways that you can go about using it. Right, very quickly, next we have the RSI, right, which is short for Relative Strength Index. So the reason why I've placed a speedometer in the image, because it works something like that. It measures the speed of change in price over selected time period. Right, just like how you see if you are traveling at a increased pace, that will be reflected in your speedometer. In the same way, in the relative strength index, as you see it moving higher, right, you know that the strength has increased. So mainly what it does is to identify overbought and oversold conditions. So overbought simply means there are no more room for buyers to come in, so that is where sellers will start to enter the market. And for oversold conditions, of course, it's the reverse, where there's no more room for sellers to come in and buyers will start to buy in the market. Of course, this is not true 100% of the time. I will cover this in the common mistakes that beginner traders tend to make later on. Right, so how do you use RSI? It's pretty straightforward. There are two clear levels in the RSI indicator. There is the 30 level and the 70 level. So the 30 marked by the green circle, right, that indicates oversold. So what oversold means, I've explained earlier. It means that price will tend to move up after that. And that is what we have observed, right? After the oversold was identified, price moved slightly higher. And the overbought level is marked out by the red circles corresponding both in the chart and the indicator. You can see as quickly as price touch the 70 level or is approaching, right, it tells us that it is overbought and price subsequently reversed and moved lower. So that is how you use the RSI indicator. Right, so that's the lesson wrap on trading triggers. Right, so we have learned how to identify the strength of price momentum and key factors like overbought, oversold using the MACD indicator and RSI respectively. So this can increase the probability of you placing in a successful trade instead of just relying upon gut feel, relying upon just sudden price action. Right, it gives you clarity in your trading. It is part of a trading plan. So this is your strategy, and remember, as I mentioned earlier, this is part of a trend following strategy. But again, I want to emphasize, as I did previously, that this is not meant to be used in isolation. Triggers are mainly the final decision that points you towards whether your decision is correct or not, your projection. So it is to be used in conjunction with the first two lessons, which is the lesson on trend and lessons on support and resistance. I hope that what has been shared so far makes sense to you. And if it makes sense, just type yes in your question box. That would help me know that you are still following me, that what I have shared so far is still clear. Right? Okay, great. So moving on, just a quick overview of the three lessons we have learned. Right? First is identifying the trend. So we have used exponential moving average, namely the 100 and 200 exponential moving average on one time frame higher than the one that we're trading in. Right, so this gives us a big picture understanding of whether prices are currently trending up or down. So secondly, it is the use of trend lines by connecting 3 lower points or 3 higher points for a downtrend. So second one, we dived into searching for key areas of support and resistance. So there are 4 ways that we use to identify that through the use of horizontal lines, through the use of exponential moving averages, multiple. So the popular ones are 50, 100, and 200. And the third way is by using trend lines. And the fourth way, again, my personal favorite, the Fibonacci retracements. So there are 6 percentages it gives you, which tells you these are the hot spots where prices tend to move towards and away from. Right, and last but not least, we learned how to look out for triggers. Right, we have covered candlestick patterns, we have covered chart patterns, and we have covered technical indicators, mainly oscillators. And so the 3 of them actually is part of your trading plan. It covers the entry rules of your trading plan. Right, so how should a complete trading plan look like? So for those of you who are curious, once you have all the other parts of the trading plan assembled, what should you be able to answer to yourself, or what should you be able to say? So I've given a statement as an example. So I, put in your own name, will only risk how many percent of my account balance. Right, so this is the risk management portion of it, position sizing, to enter a long or short trade with a risk reward ratio of. So again, this is position sizing. So part of your trading plan will cover that. On the shorter time frame, when the price on the longer time frame is above or below the exponential moving average support or resistance, right? So this is where you start to identify your entry, and it has reached or is close to the key support resistance. So that is your this is where you identify your entry and exit rules. So together with the appearance of a candlestick pattern or a technical indicator or a chart pattern. So that is your trigger. So after that sentence, it says once the trade has moved X number of pips, I will move my stop loss to break even. So that is under the post-trade management part of it. So this is just to show you that the overall picture of a trading plan is much larger. So what we have covered is actually just the entry rules of a trading plan. I hope this has helped you to give you a better understanding and awareness of what a trading plan looks like in its completed form. Right. So moving very quickly into avoiding common mistakes with technical analysis. So this happens with many people when they're first starting out, right? So the first mistake they do is to use every indicator possible. And if you can see in the chart over here, I've used 3 to 4 oscillators, different indicators on the chart, and it's basically almost impossible to tell where my prices are at the current moment. And the bigger problem with this is that what if some indicators are telling you that it is a buy signal and some indicators tell you it is a sell indicator, and let's say you act on a certain direction, how can you know for sure the next time round what are you going to do? So there is no consistency at all in this pattern, and besides too many indicators are simply an overkill. It is not necessary for you to use so many. So what I'll usually recommend is to stick to whatever we've shared, just simply a trend identifier, key area support or resistance identifier, and 1 to 2 triggers in place. Right, so total your chart will be kept clean and neat so that you can make sound trading decisions. Number 2, buying and selling on indicators alone. So this is what I've covered earlier, where new traders come in and learn about technical analysis and take it as the holy grail. So one very common one would be the RSI. Let me show you the example why this is a bad idea. So you can see in the example here, the RSI has touched the 70 level. So that should indicate to us that prices are at an overbought level. But here's the thing, you notice that price went higher. Okay, maybe that's just a fluke the first time round. Second time will be better, right? So we identified another overbought indication. So price is supposed to reverse, it did not. Right, price continued to trend around the same region and move higher. Well, maybe some say third time is the charm. So let's see that happening. So the third time we identify price and an overbought indication, and what happens? Price completely broke in an upward manner. So if you were to place trade based on these indicators alone, you would have been very much in the reds. Right, so one fundamental rule that was forgotten is that this is actually in an uptrend, so which is why you should not be looking to place short positions. So the third one would be to force a pattern or signal to enter a trade. So this is common when you do not see any prevalent trend or any setups in the current market and you wish to trade. So what we call the itchy finger syndrome, right? You just want to place a trade, you want to enter the markets, you want to participate. Right, so what happens is that you take bits and pieces of the lesson that we've learned. So for example, you spotted a doji candlestick pattern. So you remember in this webinar that, oh, I mentioned a doji candlestick is a sign of reversal. So what you've seen is that prices are moving downwards and the formation of a doji candlestick. So you tell yourself that it must be a buy signal. So if you had went long, this is what would have happened. So price would have moved in your favor for a short while, and then it would have crashed completely in the opposite direction. So this is why, again, it is not a wise move to base your decisions just on one pattern or signal. Okay, so let's move into the part that I believe that most of you are waiting to see, that how good actually is technical analysis? How can it help me in my analysis for gold, my outlook in gold, can it really tell me and postulate what the directions is? So the short answer is yes and no. So again, trading is about probabilities, but let's see what has technical analysis done for us. So this is a quick example, a forecast that was done previously. So I've done this forecast on the 24th of June 2019. So you can see, I know the chart looks a bit confusing right now, but just focusing on what I'm going to say. So as you can see, if you follow my cursor, I'm going to change this to a laser pointer so it becomes easier to follow. What I've noticed straight away is that there is a trend line that has formed, an uptrend that has formed. So this tells me that this is I can start to look to take positions which are long. Right. Secondly, there is a pattern that is being formed, a ascending triangle. Right. So this is a trigger as well as a support and resistance. Right. So sometimes a pattern, a chart pattern, does not simply serve as just a trigger. It can also be a support and resistance in that pattern. So this takes time. It takes practice for you to be able to identify that. So other than that, what else do I see? I see that a cup and handle pattern has formed. So this is a extremely powerful reversal pattern. So prices tend to break out violently after this is observed, right? And then what else do I see? Upon applying the stochastics, I see that there is a bearish divergence. So which means to say that prices will tend to move higher, right, after it's seen. And in the MACD indicator, I observe that prices are actually in a bullish momentum. So as you know, probably by now, that based on the current price of gold, we can tell that it has definitely moved much higher. And this was an analysis done on the 24th of June, right, 2019. And fast forward to today, price have broken up the cup and handle pattern over here. If you follow my cursor, violently and way higher where price is residing. Right, so this is what technical analysis can do for you before even any fundamental news has come into play, before any news of the different things happening in the market. It has already found a setup for you, a potential position that you can undertake. Right. So secondly, what we have here is so price. So secondly, what you can also do with technical analysis for your outlook on gold is to trade the short term. Right, so earlier we identified the cup and handle pattern. Okay, price broke out. So, but that took a long time, right? From June all the way till now. So that's a good couple of months or so. And maybe in between you are telling yourself that, hey, I want to establish some short-term positions to participate in the market. So that is also possible. So taking Fibonacci retracement to draw, attach the top of the price to this swing low, right? I formed the different percentages. And another thing I did was also to connect a trend line touching two of the lowest point, right? So what you can see is that prices has been rejected from the trend 3 times. So this validates the support. And what's more so is that this support coincides with a key Fibonacci ratio, 23.6%. Now let's look into the technical indicators. For my stochastics, I noticed that for the past 3 times that prices have rebounded from support, it is also in an oversold condition. Right, so this is the 3rd time. And then for my MACD indicator, what we can see is that both MACD histogram, MACD and signal histogram are above 0. So this indicates bullish momentum as written over here. So what is this horizontal line for? So this is to plot the next point of resistance should price move up, because you can see that price has reversed from this area, making it a potential resistance area. So what were to happen if I had taken this trade? So you can see in the green line over here, sure enough, it has hit my take profit region and subsequently reversed lower, but continued to move higher. So that's an example of a short-term trade, right? So Next question you might ask. So that's one example of a short-term trade. Can technical analysis help me in my forecast or outlook of gold to identify specific levels of take profit or stop loss? So the answer is yes. So let's look into this example, a forecast that I've made on the 18th of November 2019. Right. So first off, what do I notice? I notice that there is a formation of a flag pattern. So this is the flagpole that I was talking about earlier, and this is the flag that formed. So a quick spike to the upside and a retracement, right? So, and I also see price resting on the support, the bottom of the flag formation. And with each time that price rests on the support, it has also shown an oversold condition for stochastics oscillator. So this is done thrice. So at this point in time, with a flat pattern, this is a trend continuation pattern. So what this tells us, this is an uptrend, right? I've spotted the support via the flag pattern. I have my triggers are that the stochastics oscillator is showing me oversold condition not once, not twice, but thrice. This is the third time it showed me. So I go ahead to plot my potential take profit region. So how do you plot potential take profit regions? So basically these are the next resistances you will encounter, that you think that you're most likely to encounter if you're in a long position, and if you're in a short position, the take profit region are the next potential support that you would encounter. I hope this makes sense to you so far. So what happened next? So it went on. So this is the day that I performed the analysis, right, on the 14th November 2019. So the decision was to go long. So this is the first region that I have projected. Second region, third region, and fourth region. So basically it have broke past all four potential take profit regions that I have set in place, and then subsequently priced both higher. But the point is this, that just based on the technical analysis alone, I was also able to see not only direction, short-term trades, but also pinpoint with accuracy where could price potentially move to. And that is how technical analysis can help you in your trading, right? So now I'm going to quickly shift into our Phillip MT5 platform to give you a current outlook from a technical analysis perspective on MT5. So let me just quickly do a exit and come into my platform. Now, so this is the Go daily, right? This is the Phillip MT5 platform. It is extremely intuitive to use. In just a couple of seconds, if you allow me, I'm going to show you why is that so. So very quickly, I want to establish the trend, right? So let's say I'm looking at a daily time frame. I want to trade on a daily time frame. So what I want to do is that I will move into a weekly time frame and I will apply a moving average, right? So 200 moving average, exponential, and I want to choose the color. So this is all completely customizable to me. I can choose for it to be in a dotted line or a broken line, right? And the thickness of it. So I select OK. So this is the 200 exponential moving average. So it tells me that it is pointing upwards, prices are above it, so this is an uptrend, right? So what this means is that I should only be looking to take long positions. Right, so the next thing I want to establish would be my key areas of value, support and resistance. So for this, I would use my Fibonacci retracement to draw from this top, connect to the bottom of this region. Right, so immediately I have my key support area and resistance. So if you were to look historically back into the charts, so I've mentioned that Fibonacci ratios give you a very good reference point for where these regions are. If you can see, actually this is very accurate. So prices moved into these regions, bounced off, came lower, and continued for this bouncing back and forth within these regions for a couple of times, right? And so this is how I formed my support and resistance. And to add it off, at the bottom, I want to add my stochastics oscillator, right, to give me potential trigger. And I want to add also my MACD to give me a sense of what is the current momentum. So what I can see right now here is that let me move this. So this is done on a weekly chart. My apologies, I should have taken this back into the daily time frame where I was trading. So this is, we have established an uptrend. So let me just quickly plot this out here and show you how quick can this be done. I plotted the points, drag this across, pull out my stochastics and pull out my MACD indicator. There, in just a couple of seconds, you can see that this is formed. Right, so what you can see here is that prices now seem to be resting at the top of this resistance level. So a dangerous stock can come into mind. Oh, what if I were to place a short position, because price seems to be resting at a resistance, but this is only one factor, as we've mentioned earlier. So in today's sharing, what we've covered is that we want to wait for all three factors to align, for trend, for value, for trigger to align. So sometimes, or rather most of the time, what you will observe is that actually you would have to wait for your setup to occur. Right? So when you are waiting for a long position, what do you want to see? So number one, just very quickly, let me draw here. You want to see that oversold signal. Produced, right? So very quickly, you can just add in your own notes. You want to see that the MACD is showing positive momentum, right? And next, what I want to see is that where could price potentially reverse from? So let's spot further resistance. Over here, I can see that lines have coincided on 3 occasions. One here is the resistance and 2 support. So I would name this support 1, support 2 being the 61.8 ratio, hit ratio, and support 3, right? S3, which is the 50% fit ratio, right? So once this is set in place, you can simply let your charts run over time and observe your charts again and see if everything aligns. So again, today, what I am sharing does not constitute investment advice. So I'm sharing to you today is key levels that you can potentially look for setup for. So how can you take advantage of what we've shared today? How can you take action? Right, so I just want to share with you very quickly. I know we're running out of time. Right, is that we are currently running a trade go for gold promotion. So you have learned something from the webinar about an outlook to gold, about technical analysis, and you feel that you want to participate in the market. Right now, now is the best time to do so because we have a trade go for gold promotion. So basically, there are 4 things that you need to do to take action. You need to join the PhillipCapital Telegram group. Don't worry, I'll show you the instructions later on for how you can do it. Open an account with Phillip Futures, trade simply 1 lot of spot gold, and you can stand to receive. You will receive the 24K gold plated golden red medallion, right? Because this year is the year of the red. So what I want you to do quickly right now is to join the PhillipCapital Telegram group. If this is you, you want to take action, you want to join and take part in this promotion, here is what you can do. Just simply scan the QR code and you can see the example. You can see the example on the right of how I scanned the QR code to join the PhillipCapital group. So in this group, what you can receive is our analyst views on gold, basically. So you can tell on the left the outlook on gold shared on 14 January 2020 that is backed up by different charts, different levels, that show you in this chart, they also will reveal to you certain key pricing movements and opportunities that you can identify in the market. So if you have yet to join, don't hesitate. So again, let me replay this video. What you can do is simply pull out your phone, scan the QR code, and you should be able to join the group. So if you do not have a Telegram, you need to download that on your App Store or your Google Play Store. Right, so this is available, Telegram app. So pardon, I think there is an error. Yeah. So this is playing. Once you scan, you'll be brought to this page where you can join the Telegram group. Okay, great. I see a couple of you joining now. Just giving you a little bit more time for you to scan the QR code. So once you join, you can just scroll back up into the chat and view different conversations that have taken place, the different promotions that we're running, and even more information on the promotion, right? Just for you to find out more. Okay, great. So moving on, if you need me to move back later on, just type that in the question box so that I can tell that you need me to move back. Right, so if you need me to move back, just let me know in the question box. So very quickly, next point, what you want to do is to open an account with Phillip Futures. Right, so now we have integrated with My Info. So to open an account is extremely simple. Right, it just requires no more than 10 to 15 minutes as compared to the regular account opening. So if you're a Singaporean, right now what I would recommend you to do is to scan the My Info QR code for you to open an account now. So the question is that some of you may think, you know, I'm not ready to trade. I do not want to trade right now. But that's okay, because what you can do is to first open up the account, go through the administrative process, because we know that it takes some time, so that when the opportunity presents itself, as you have seen earlier, right, as I've identified the different opportunities, then you will be ready to place your trade. So this is extremely key. So so as I've showed you also in Phillip Futures, we have integrated with MetaTrader 5. MetaTrader 5 is extremely intuitive. You've seen me go through the demo earlier. It's so easy just to pull out your technical tools, technical indicators, draw, change, edit, whatever you need. So it has integrated with so many friendly features, and I've not even covered things like auto chartist, in which we have integrated with, which is a chart pattern recognition. So what can it do for you? Basically, in your trading plan, it has already identified one of the steps for you, right, which is your trigger, which is most often the hardest thing to do, because most of us have a full-time job, right, and we only view the market at the end of the day. When we go back home, we only have a couple of hours to view the market before we go to bed. And so what you can do is to set your trend in place, the big picture trend. You can set your support and resistance in place, right? And all you need to do now is to wait for auto chartists to pick up the chart patterns for you to decide when to trigger the trade. Because think about it this way: if you are to observe 10 different currency pairs, or you were to trade gold, right? Each day you go in, you have to reconstruct a new trigger pattern. You have to look out for new trigger signals again, because the chart will have refreshed. But the good thing about auto chartist is that it refreshes 24 hours. As long as the market is open, is in your watch list, right? It will scan for different chart patterns. So that is auto chartist, and beyond auto chartist, to share with you something even greater is trading central indicators. So while auto chartist is a chart pattern recognition tool, trading central is a candlestick pattern recognition tool, right? So now you have two kind of trading signals in one platform, and that's something that you can view all together. Right, so the question is, can they be used all together? The answer is yes. The next question you will ask is it free? So the answer is also yes. So if you are a Phillip Futures client today and with a MT5 account, both of these services, both of these premium services are made free to all clients. So if you would like to be part of Phillip Futures, and also to be our client on MT5, just scan the QR code, fill in the information that is required. If you have My Info, that's great, because it will take you just a couple of minutes to complete the form. Right, so let me just quickly move on. Right, so the third thing you need to do is to start trading. Right now, I also have taken the chance to showcase the mobile platform. So earlier you have seen the example of the desktop application. So right now, what I'm showcasing on the left is also the example of how the mobile application looks like and how you can place a trade on Go. So in MT5, Phillip MT5, the ticker symbol for Go is XAUUSD. So all you got to do is tap on the charts, simply click buy or sell, and you'll be on your way to placing the first trade. Okay, so for some of you here who have not scanned the account opening, maybe you're thinking to yourself again, okay, you do not have experience in trading, you still need more time to consider. That's okay, because we do have a demo account. So if you can see the link that is provided, www.phillipfutures.com.sg/demo. So that is where you can get a free demo with 100,000 virtual credits. So what does virtual credit means? Virtual credits are not real money. So this is where you can test out the platform, you can test out trading, you can test out different strategies, even what we talked about today. Try drawing on the charts, editing, and I'm sure you'll find how intuitive it is. Right, so there is that option for you. Right, so with that, I've come to the end of my presentation. So I thank you for your kind attention today, for staying here with me, for taking your evening. I know I've overrun by a bit. I apologize for that, but I hope that you have learned something important today, something valuable. So once again, thank you and have a nice evening.